Good afternoon, ma'am. Good afternoon, classmate. So, my name is Maria Kristel Makawiwili. My topic for today is business and financial risk. In this chapter 8, we examine risk from the viewpoints of an individual investor, and we distinguish between risk on a stand-alone basis, where an asset cash flows are analyzed by themselves, and risk in a portfolio context, where cash flow from a number of assets are combined and consolidate cash flow are analyzed. So first we have a financial risk is additional risk placed on the common stockholders as a result of the decision to finance with debt. Conceptually, stockholders face a certain amount of risk that is inherent in the firm operation. This is its business risk, defined as the uncertainty inherent in projections of future operating income. If a firm uses debt or financial leverage, this concentrates the business risk on common stockholders. So, to illustrate, suppose 10 people decide to form a corporation to own and operate a large apartment complex. There is a certain amount of business risk in the operation. If the firm is capitalized only with a common equity, and if each person buy 10% of the stock, each investor will share equally in the business risk. However, suppose the firm is capitalized with 50% debt and 50% equity, with five of the investor putting up their capital as a debt and the other 5 putting up their money as equity. The debt holder will receive a fixed payment, and it will come before the stockholder receive anything. Also, if the firm goes bankrupt, the debt holders must be paid off before the stockholders receive anything. In this case, the common stock will be twice as risky as the would have been had the firm been financed only with equity. Thus, the use of debt or financial leverage concentrate the firm business risk on the stockholders. Second, business risk is the single most important determinant of capital structure, and it represents the amount of risk that is inherent in the firm operations, even if it uses no debt financing. Dito, we are going to use this formula, ROIC equals EBIT 1 minus T, or total invested capital. A commonly used measure of business risk is the standard deviation of the firm return on invested capital, or ROIC. Recall from the chapter 4 that ROIC is defined as follows. So, ito nga yung gagawin nating formula for ROIC equals EBIT 1 minus T, or total invested capital. ROIC measures the after-tax return that the company provides for all of its investors, because ROIC does not vary with changes in capital structure. The standard deviation of ROIC measures the underlying risk of the firm before considering considering the effect of debt financing, thereby providing a good measure of business risk. We use Big B Electronic, a debt-free, unlevered firm to illustrate business risk. The top graph, this graph illustrate figure 14 show the trend in Big B return on invested capital or ROIC from 2009 through 2017. Graph like this show security analysis and managers how much ROIC has varied in the past and thus might vary in the future. The lower graph show the probability distribution of Big B's ROIC based on the 2009 to 2017 data given the top section. Big B's ROIC fluctuation were caused by many factors, booms and recessions in the economy, successful new product introduced by Big B and its competitors, labor strikes, a fire in Big B's main plant, and so on. Similar events will doubtless occur in the future, and when they do, the realized ROIC will be higher or lower than the expected 9.0%. Further, is always the possibility that long-term disaster will strike permanently depressing the company earning power. For example, a competitor might introduce a new product that makes Big B products totally obsolete and puts the company out business, much like what happened to buggy manufacturers when automobiles were invested. The more uncertainty there is about future EBIT and thus ROIC, the greater the company's business risk. Big B uses no debt, so its stockholders currently face only business risk. However, if it is used that its stockholder would face the existing business risk plus some additional financial risk. Business risk varies from industry to industry and also among the firm in a given industry. Further, firm business risk can change over time. For example, the electric utilities
for many years regarded as having little business risk, but over the past few decades, utilities have faced increased competition and greater uncertainty regarding potential environment regulation, both of which have somewhat increased the industry risk. Today, food processors like Kraft Heinz and Pillsbury illustrate companies with low business risk, while cyclical manufacturers such as steel companies as well as new start-up companies have high business risk.
factor that affect business risk. Business risk depend on a number of factors including the following. First, competition. If a firm has a monopoly on a necessary product, it will have monopolistic firm prices are often regulated and may not be able to raise place enough to cover rising costs. Still other thing held constant least competition lowers business risk. Number two, demand variability. The more stable the demand for a firm product, other thing held constant, the lower its business risk. 3. Sales price variability. Firm whose products are sold in volatile market are exposed to more business risk than from whose output firm firm whose output prices are stable, other thing held constant. 4. Input cost variability. Firm whose input costs are uncertain having higher business risk. 5. Product obsolescence. Firm in a high-tech industries like pharmaceuticals and computers depend on a constant stream of new products. The faster its product become obsolete, the greater a firm business risk. Foreign risk exposure. Firms that generate a high percentage of their earnings overseas are subject to earning declines due to exchange rate fluctuations. They are also exposed to political risk, regulatory risk, and legal exposure. Firms operate in highly regulated industries such as financial services and utilities are subject to change in the regulatory environment that may have a profound effect on the company current and future profitability. The extent to which costs are fixed. Operating leverage. If a high percentage of its costs are fixed and thus do not decline when demand falls, and this increases the firm business risk. This factor is called operating leverage, and it's discussed in the next section. Each of these factors is determined partly by industry characteristic and partly by managerial decision. For example, Big B could reduce input cost volatility by negotiating long-term labor and supply contracts. By it might have to pay more than the current spot price to obtain such contract. That's all. Thank you.